So thanks to the calamity in the recent banking crisis, the Federal Reserve has recently just confirmed that a recession is going to happen.
This is bad.
Now there's good news and then there's bad news in this. Now we obviously know the bad news is that a recession is not good. However, the good news is multiple talking heads over the past few months have mentioned that the recession is going to be mild.
The effects of the banking turmoil would likely lead to a mild recession later this year.
A mild recession towards the end of 2023.
Now the problem with this is that the feds don't always forecast everything exactly right. Now in this recent job report, we're actually seeing jobs tick upwards. And if you pay attention to the unemployment rate, we're actually at extreme low levels of unemployment. Now while having a robust job market is actually a good thing for the economy, this actually poses a harder, difficult job for the Fed. Because in the recent rate decision, we heard Jerome Powell, the chairman of the Federal Reserve, state that a pause is going to possibly happen if the data is looking good. And the problem is the data is actually not looking good. See, many politicians, when they talk about the story of inflation, they point to this chart over here, which is just a regular CPI report. It looks good. It looks like inflation is coming down. However, the real story is slightly different. Because when you look at core inflation, which excludes volatile items such as food and energy, we're still at very high levels, and it looks like we're actually ticking upwards and not going downwards. So this is creating a serious situation where we have the Fed trying to fight inflation, or better yet, core inflation, by using one of their tools in their tool belt, which is hiking interest rates at the pace that they're doing, and they're doing it at this specific pace because they're trying to have a soft landing or a mild recession. But the problem is what they're doing is actually breaking stuff in other areas where they're breaking the banking sector. This is why we're seeing a lot of regional banks struggle. We saw some collapse, we're seeing more struggle, and this is why we could potentially have a more serious, harder recession because of a credit crunch. This is why we have news outlets explaining why a recession is most probably going to happen, and in this recent article by CNN, they actually say that the credit crunch has a 50% chance of actually happening. Guys, a 50% chance of actually happening. Now this would really slow down the economy.
I honestly think the economy might collapse.
Now, for those of you guys watching that want to keep up with what's going on in the economy, I highly suggest you guys check out the links in the description of this video, because one of the links is going to be a link to a free weekly newsletter where every single week I'm going to go ahead and send you guys what's going on in the overall economy. Now, with that being said, if you guys want an even deeper look to really parse into data and see what's going on, also check out the first link, which is going to be a link to the Push and Profit private group, where I give you guys daily, trends of what's going on in the market, and I also put out potential trade ideas that I'm looking for today. So definitely check out the links in the description of this video. But to give you guys a vivid look of how this inflation battle is actually looking, I want you guys to take a look at this chart that Wells Fargo put out, where it actually just really displays how inflation is looking. And we see that energy is going down, we see that food is going down, but we see that core goods and services is that sticky inflation. So again, this is the problem. Inflation is going down, but core inflation is not going down. Now we know that going forward, we have another CPI report coming out May 10th, and this will give us a better insight on how inflation is looking. But on top of that, further on into the month, we also have a PCE report, which is the Personal Consumer Expenditure report, which is actually another inflationary gauge that the Federal Reserve actually prefers to look at. So that's coming out later on in this month. So we have two reports coming out this month that we actually want to pay attention to, because this is going to tell us how the battle of inflation is really looking, and it's gonna give us an insight of what the Fed is probably gonna do.
The Fed will do something.
But being honest, the Fed is probably gonna make things worse because they were too late to the battle. Now, before I go ahead and provide more of my thoughts on this, I want you guys to do me a favor and comment in the comment section below, if you can, to let me know what your thoughts are on this, right? I want you guys to let me know, do you guys believe a recession is happening, or it's not happening? And if you do believe a recession is happening, is it going to be a mild recession, or is it going to be a hard, painful recession, right? Only if you could comment that below, let me know, right? But, more on my thoughts, right? So the main concern I have is really the credit crunch, right? And that's the whole thing with the whole banking sector. I mentioned this in a previous video where I talked about, a lot of these regional banks, they have a large exposure to commercial real estate, right? And these commercial real estate loans are different. They're not like your traditional, real estate loans where they actually are non-recourse loans and they have to get refinanced every so often. And with rates so high, a lot of these, financial institutions that are regional banks are going to struggle a little bit more. And once these banks struggle, well, that could cause a massive credit crunch, where that's where we see, economy or the overall economy basically stifling. So that's the main concern, really, the credit crunch. Now, there are other scenarios, because this doesn't necessarily have to happen, right? Another scenario is maybe the Fed actually doesn't hike rates anymore, right? Maybe they actually do a pause, they stop, they don't worry about inflation, and they don't hike, right? But then in this scenario, we start to see inflation kind of creep back up again, and then force the Feds to have to hike again, and then put us back in a recession. So two scenarios where we kind of have a recession, right? Now, there's a third scenario that I kind of see, and this is a scenario where I actually really hope is true, but it may be the least likely.
I hope it's true.
Now, in this scenario, it would be, a situation where the Fed doesn't hike anymore. Inflation actually does come down. Core inflation actually does come down, which is good. We see very minimal job losses. People continue working, and then we have such a booming economy. Now, I absolutely want this to happen. Do I think this is going to happen? Chances are slim, right? Obviously, we can't rule out the possibility of a non-recession happening. However, I think that the other two scenarios are more likely to happen, right? So that's just my thoughts on this. Again, I want you guys to know that I do not have a crystal ball. I cannot predict the future. And one of the things that we have to do is stay data driven. This is why, I pay attention to all the latest reports that come out, and I like to parse through the data in order to see what is actually happening, right? Because I can't predict the future. I just look at what's happening and say, okay, well, this is happening.
It's happening.
Now, as far as what's happening with the S&P 500 or the NASDAQ ETFs, what we're seeing is a similar story where, stocks capitulated back in 2022. Rates were being hiked, the macroeconomic environment was changing. However, in 2023, we're seeing a different story. We're seeing this rally off the harshness, right? Some people may even say a ralito, right? Things are looking good. However, one of the things I caution the Push and Profit Private Group is, hey, we have to be careful moving forward into 2023, because we may have sort of a two-phase type of year where, we start off rallying, however, things actually get worse on the second half of the year. Why? Because the macroeconomic environment still hasn't changed. In fact, it actually may be getting worse. Now, something else I also explained to the Push and Profit Private Group is that in a bear market, a lot of individuals believe that the market just goes straight down. However, that's not really the case. In a bear market, we oftentimes see a bunch of mega rallies. In fact, if you want a prime example, just look at 2022 when prices capitulated. You'll still see that there were a few rallies in 2022 before the market fell down. And the reason this happens is because, there's a saying in the stock market that bulls take the stairs and bears take the elevators. Now, the reason this occurs is because as people are participating into the markets, what do? They kind of add in increments little by little, buying. However, when there's panic happening and panic mode just turns on, well, everyone just sells everything all at once and everything just kind of collapses down. So one of the things I kind of, say is that we have to be a little cautious as we move forward into the year. Now, with that being said, make sure to like this video if you haven't done so already. Also consider subscribing to the channel if you're not subscribed. And also make sure to watch this next video right over here. And I'll see you guys on that next video. Take care, guys.